Hi everyone, Daniela Cambone here for ITM Trading. I have had the privilege and the honor of doing a career I love for close to 20 years, and I have met thousands of the most insightful and intelligent people on the planet. There is just so much wisdom, lessons, and insights I have gained in terms of building an incredible portfolio and preserving your wealth. And we want to share those insights with you today. We have put together a free report that highlights some of the best knowledge I have acquired through all these years. You can get it today for free at DaniReport.com. Again, that's Danny, D-A-N-I, report.com. Don't miss out, get it now. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show here on ITM Trading. Gold keeps making fresh, new all-time highs, and look at the silver price on a tear here. Here to talk about this and so much more is George Milling-Stanley. He's the chief gold strategist over at State Street Global Advisors. George, it has been too long. How have you been, my friend?
I've been excellent, thank you, and it's been wonderful to have the opportunity to watch gold in particular being on a real tear here.
Absolutely. And obviously you do deep dive analysis on gold, on precious metals, basically on a daily basis. So I'm just thrilled to have this conversation with you today. And I wanted to start by recent comments by two very prominent figures, obviously Mohammed El-Erian and Ray Dalio, the former PIMCO CEO, saying that something strange has happened to the price of gold over the past year. In setting one record level after the other, it seems to have decoupled from its traditional historical influencers such as interest rates, inflation, and the dollar. Do you agree that there are strange things brewing in relation to the gold price, George?
I'm not aware of any strange things brewing. I think that if you look at the background against which gold operates, then historically this kind of background has always been favorable for gold. And here I'm looking both macroeconomically, at the geopolitical circumstances we are in, and at developments in gold's internal market dynamics, the balance between supply and demand. Let me say what I really mean, that economically, we have finally started on a sustained move to cutting interest rates by the Fed. I think that's important. Not that there's really any direct relationship between gold and interest rates. I think that the relationship is between gold and the dollar. And now that the Fed has embarked on a sustained period of rate cutting, that's when I would expect the dollar to continue to weaken and effectively to revert to the mean. If you remember, in the fall of 2022, the Fed put rates up by 75 basis points at 3 consecutive meetings. That drove the dollar to a 20-year high against any other currency and was something of a headwind for gold in 2022. Now that the Fed has made it clear it's embarked on a sustained period of cutting rates, I would expect the dollar to weaken, and it's logical for gold to strengthen. As far as the geopolitical atmosphere is concerned, we have an armed conflict in Europe between Russia and Ukraine with the potential to turn nuclear at the push of a button. The conflict in the Middle East was originally just within the borders of Israel. It's now spread to open conflict between Israel and Lebanon and Israel and Iran. I think this is all very, very concerning. So I think that the geopolitical backdrop has also been favorable for gold and remains favorable given the failure of anybody to really get peace talks going. And then there's a few things in the internal market dynamics, continued very strong central bank buying, a revival of investment demand for gold in China because of worries about the stock market, and revived Western world investment because of those macroeconomic and geopolitical factors that I just mentioned. So I don't think we need to point to anything weird happening in gold at all. I think this is a perfectly logical response to the situation where gold finds itself right now. To dig a little deeper to what he was getting at is that it's a trend that the West, United States, should be paying more attention to. That the rise in gold
is actually more telling of the breakdown of the US dollar, or countries looking to move away from the dollar? I say this as the BRICS summit is unfolding, George, and there's talk of, a BRICS own payment system, decoupling from the US dollar, a rebellion from the US dollar.
I think that what we're looking at, whether you think about the BRICS or the changes in the international monetary system, I think the pace of change in the international monetary system is glacial at best. I am not expecting the dollar to lose its dominant position in international official reserves or in the settlement of trade transactions. I think what we're seeing, though, we have been seeing for a number of years now, this is not something new, even if it's just crossed El Arian's desk. What we're seeing is a gradual unfolding of a gradual erosion of the dollar's dominance, which has been in place for 100 years or more now. And I think that this is going to continue, but I don't think it's going to end the dollar's dominant position at all. I think what we're seeing is a growing reliance by especially emerging market central banks on gold in their official reserves. That's a trend that's been with us now for 14 and a half straight years. So that's not something new or weird on the horizon. I think we're also seeing a very gradual diminution in the use of the dollar in the settlement of international transactions. And that's, I think, partly for practical reasons, but I think it's also for political reasons. There's an awful lot of countries out there that really don't like us very much, Danielle. I'm sorry to have to say that, but I'm afraid it's true. And I think that a number of those countries have been looking for the possibility of alternative ways of settling international trade rather than using the dollar. I think it's very different. I mean, they've been doing this, trying to find ways to do this for a very long time, but it has proven very, very difficult to do. I'm not holding out any great hopes for anything that the BRICS might come up with their current meetings in Russia. I'm certainly not expecting them to launch a gold-backed currency anytime soon. That belongs with the conspiracy theorists in the outer reaches of the blogosphere, Danielle.
Why do you say that, George?
I just don't think it's a practical reality for anyone to want to back their currency with gold. I think if you think about it, President Nixon back in 1971 ended the last formal legal link between gold and the dollar, and there is now no currency in the world that has any kind of link between gold and currencies. And I think that it is unlikely that any government would be prepared to accept the rigorous economic discipline that being effectively on a gold standard would mean. I think that means that essentially if you want to increase the issue of currency, then you need to buy gold in order to back it up. That was the way the classical gold standard worked from 1870 about to 1971. And I don't think there's a government out there that would want to have to do that. It means that you can't have anything like we used to call Keynesianism. You can't have quantitative easing unless governments, if they're increasing their issue of currency, then they have to go out and buy gold to back it. And I really don't think that that's going to happen. What's happening in the emerging market official reserves is that they have become aware that with more than 2/3 of their official reserves in dollar-denominated debt instruments, they are overexposed to the dollar. And with less than 5% of their official reserves at mark-to-market, then they're underweight in gold, certainly underweight compared with their population's love for gold. Most of their populations probably have more than 5% of their wealth in gold. So I think these governments, many of them, there are 16 or 17 of them in the emerging markets, have been steadily moving to gradually reduce their overdependence on the dollar and to increase their underweight position in gold. That's not something that has only just happened. It's not something weird. It's a process that's been going on for 14 years and is going to continue to go on, as far as I can tell.
Then why, digging a little deeper as to why central banks have accelerated their gold buying, though, George. Like, we've seen them take a bit of a pause now, but there has been an acceleration in a short period of time of gold buying. Why is that?
Look, I think there's a couple of reasons. First of all, I think that in spite of 14 straight years of buying of gold by emerging market central banks, they really haven't moved the needle that much. they still have well over half of their reserves in dollar-denominated debt, and they still have less than 5% in gold, partly because their official reserves, of course, have been growing because of their relative economic successes. So I think there's a logical reason why they would want to speed up. There is another factor that comes into play, and this is that a couple of years ago, as some people characterized it in the media, the US government decided to weaponize the international payment system by booting Russia out of the SWIFT system. And I think this gave pause to a number of other governments around the world, governments that either have upset us in the past or are contemplating upsetting us in the future. And I think what that did essentially was it reduced the attractiveness of holding a large part of your reserves in dollar-denominated debt in Western banks, which tends to be where they hold those dollar reserves. And it increases the attractiveness of the one official reserve asset that's universally acceptable and entirely anonymous and can be taken home and stored at home, and that's gold. So you've got a long-term trend, and then you've got a relatively short-term trend as a result of the action we took with respect to Russia and SWIFT. And I think that's probably the reason why things have accelerated. We saw central bank purchases double in 2022 to an all-time record high. They were within about 1 or 2% of that all-time record high last year. And so far, we only have first half figures, but net central bank purchases in the first half of 2024 were the highest in any first half in history. So I think there are very sound logical reasons, nothing weird here going on at all, very sound logical reasons why the gold price is behaving as it is.
Okay, one more point, because I mentioned Ray Dalio, founder of Bridgewater, largest hedge fund in the world. He has been doing this for many years now, sounding the alarm on the economic paradigm shift that could dramatically reshape the financial landscape. He says a landscape that if you don't own gold, you know neither history nor economics. So urging folks to own gold during these trying times. He predicts that within the next 18 months, we may witness a significant economic contraction and a restructuring of debt and finance that he says will catch many unprepared and by surprise. Thoughts on Dalio's view of gold then? How vital, do you agree that it is vital to own gold through these times?
I think Ray Dalio is doing a very good version of my job here, Daniela. I agree. I always believe it's a good idea to have some gold in a properly balanced investment portfolio because I believe it offers protection. Its diversification benefits doesn't correlate strongly with anything in a typical investment portfolio. So it gives you diversification benefits. It spreads your risk. In other words, it also gives you some protection against inflation. And I don't think inflation has gone away yet. It gives you some protection against potential weakness in the equity market. And I think that is a very serious possibility, given that Jerome Powell, I believe, still wants to see an extended period of below trend growth, to quote him verbatim. And it also offers you some protection against potential weakness in your currency, whether your currency is the US dollar, the Chinese renminbi, or the Indian rupee. So I think all of those protections are a very, very good reason why people should always own some gold. I think the fact that gold sometimes, not every year, but sometimes gold will also offer you significant price performance. I think that's another reason why it's a good idea to own gold. And gold has certainly offered you performance this year, with the price up more than 30% year to date, more than 40% on a trailing 12-month basis. Gold has done extraordinarily well and looks set to continue to do so unless something changes in the background against which gold's operating, Daniela.
When you say continues to do so, I know in past comments you had a hard time seeing gold hit $3,000, I believe, by 2025. Is that correct? And have you revised that forecast?
No, I haven't. What I've said in the past is that an awful lot of people on Wall Street have been predicting that gold would break the $3,000 barrier this year, and that I didn't necessarily see that was going to be the case. We've already increased more than 30% in the price in this calendar year. And I think it's perhaps a little greedy on the part of investors to hope for another 10 or 20% increase above where we are today. But I think that $3,000 is obviously a distinct possibility sometime next year, if the situation does not improve in any way at all. In other words, if the situation macroeconomically, geopolitically, and as far as gold supply demand developments are concerned, if the situation remains unchanged from where we are, I think there's a very real possibility that we might actually see prices above 3,000 next year. I'm certainly not ruling it out for 2025, but I think, suggest that to me, it seemed a little unlikely for gold to want to go on that much of a tear in what remains of this year, which isn't really very long now.
George, what do you say to people who perhaps have not entered gold yet or have not added to their gold position because of the levels they're at? I mean, I've spoken to various sources at various bullion dealers across the nation, and we're not really seeing the retail investor, show up. I mean, I get the Costco stories about their gold bars flying off the shelves, but some investors hesitant to enter here because they see it as a high price for gold.
Yeah, I can understand that, and I encounter that kind of feeling at all times. What I would say is that I don't believe that market timing is a really good game to play. I've been in financial markets for more than 50 years, and I've never been good at market timing any more than I'm good at second guessing what the Fed is going to do. But what I do believe is that gold comes into its own as a long-term strategic allocation, and that if people don't have any allocation to gold, then I think it's really largely a matter of irrelevance at what price they decide to get in. The price is very important. The entry price, if you like, is very important if what you're hoping to do is to sell gold when it's gone up in the next couple of weeks and make a big fat profit. I think that's the wrong way to play gold. I like gold for its protective capabilities, as I outlined just now, and I think that those really come into their own with a long-term strategic allocation. So I'm not recommending anybody to get involved tactically at all, and I think that's the main reason why a number of people have held off, thinking that, well, this price is going to come down, I'll have an opportunity to get in at a lower level so that I can get out fairly quickly. And I don't think that's the smart way to play gold. Gold is a protective asset primarily, and I think that that's really where it comes into its own.
It is wealth preservation for you, George?
Exactly, wealth preservation, and sometimes it will help to create wealth. In other words, sometimes you will get returns. And that mantra of protection plus performance is a very powerful one. And that's what we have seen from gold so far this year. And what a lot of people are hoping we'll see go on into the future. As I say, if things stay pretty much the same, then there's no reason why gold shouldn't continue to go up, because this kind of background historically has always been favorable for the gold price.
Let's get some comments from you on silver, because it's really having a moment here. Are there other dynamics at play in the silver? I mean, what's causing the silver run for you?
Yeah, look, I think an awful lot of the silver run is being caused by the run that we have seen in gold, and the fact that a lot of American investors believe that silver is a better bet because it's cheaper. And I don't think that's necessarily the case. The demand dynamics, the supply and demand dynamics for gold and silver are totally different. Most gold is produced from gold mines where gold is the primary product. It is very, very small proportion of mine production that comes as a byproduct of other metals. That is the reverse with silver, where most of silver is produced by people mining lead and zinc, or by mining copper, or even mining gold. There's a lot of silver produced as a byproduct of gold, copper, lead, and zinc mining. So that it is not necessarily the primary product. I think the other thing that's worth bearing in mind, gold's demand dynamics, with a little under half going into jewelry every year, with about a third going into investment, with something close to a quarter going into central bank buying, and way less than 10% going into industrial and technological applications, is very different from silver. More than 2/3 of silver is consumed in high-tech imaging for the scientific and medical professions. It's used in pollution control. It's used in water filtration. It's used in bactericides. It does wonderful things, but they are almost entirely industrial applications, which means that silver's price is much more dependent on levels of GDP growth in the advanced economies than is gold, where nearly half of gold goes into jewelry, most of it going into the emerging markets, so not linked to the US economy at all. I think it's a very, very different dynamic at work here. And I think that what silver is doing is playing catch up, playing follow the leader. And I'm a little concerned about what's happening with the silver price at this point for those people investing in it right now.
You are, sorry, did you say a little concerned?
I'm a little concerned, yeah. I don't see the prospects for silver having anything to do with the prospects that I've outlined as far as gold's concerned.
So what working forecast are you looking at for silver?
I'm definitely not optimistic about where silver might be going from this kind of level.
What's the biggest bearish reason why?
I think that there's a serious possibility that Jerome Powell might eventually keep rates high enough to get his extended period of below trend growth in the US economy. That would mean a decline in GDP, and that would probably mean a decline in silver usage at the same time. So if silver usage is likely to go down, as it is in my view, especially if that decline in US GDP becomes global, which is, of course, often the way that the US is the engine that drives an awful lot of economic performance around the globe. If we start to see falling GDP globally, then I am not confident of the outlook for silver because it's heavily dependent on GDP. Gold is not.
Comments on the Fed. We're speaking ahead of the next highly anticipated FOMC. George, is the Fed on the right path?
I believe that they are right to start cutting rates. I agree with Jerome Powell that they probably should have started cutting them a little earlier, but they did their best to make up for that by giving us a 50 basis point cut in September. They've got 2 more meetings. The indications at this stage, and this can change on a dime given any new set of economic statistics, because Powell is being data-driven, as he always points out, but the indications are that we're going to see a 25 basis point cut in November and another 25 basis point cut in December, that the Fed will continue reducing rates gradually through 2025 unless anything comes along and upsets the apple cart. And then they'll probably have a pause and rates will probably be at around about the 3% level, still a little bit above what many economists regard as the natural balancing level of rates, that they will then have a pause in 2026 and see exactly where the markets are. That is what Powell has outlined. But as I say, he has stressed that he's going to be data-driven. I hope that means he's not going to jump on 1 month statistics and make perhaps an unwise move. But I think in general, he has demonstrated the ability to ignore 1 month statistics and look at general trends in the economy. I think Powell's done a pretty good job, except that, as I say, I think he was slow to start to raise rates. I think he has been slow to start to cut rates. But maybe being a little bit slow isn't such a bad thing after all. And the markets, I think, were very happy with the 50 basis point cut we got in September. And I think they have now basically resigned themselves to no more 50 basis point cuts unless there's some weird data statistic comes out in the next month or so. And I think that they're resigned to a relatively gradual pace of easing. Whether that's going to be enough to generate that extended period of below trend growth that Powell wants to see, I just don't know at this stage. I don't think Jerome Powell knows either.
A comment from you on the general economy, George. I mean, we saw the fiscal numbers for 2024 for the U.S. and some staggering numbers and statistics there. Are there certain numbers that you're looking at that are major red flags for you?
No, I think what I'm trying to look at is the whole picture. I think that looking at that's really the only way. Otherwise, you do tend to get sucked into thinking, oh my gosh, the unemployment number went up 10 basis points last month. That's disastrous. We must do something about interest rates at once. I think it's important to look at the whole picture. There's not one set of statistics that I look at. I look at everything that comes across my desk in the macroeconomic sphere. I look at everything that comes across my desk as far as geopolitics is concerned, and the same with the internal market dynamics. Those are the three areas that I study. And basically, I base my opinions on the balance of all of those three sets of factors, all of which can be important drivers of the gold price, and the importance of which changes sometimes within a day or so. So I have to look at all of those things and then base my judgments on the whole picture, not just on one red flag that might emerge.
Well, let me ask you this. U.S. budget deficit topping 1.8 trillion in fiscal 2024. My question to you is, I guess I'm just trying to understand your viewpoint of the trajectory we're on. Is it sustainable?
You know, I've been hearing that our budget deficit and that our general debt level, for that matter, are both unsustainable. And I've been hearing this for 20 or 30 years. I believe what the economists tell me, that they are unsustainable. I'm not quite sure how we unwind these. I'm listening to what the two presidential candidates promise, and it looks like there's going to be more spending. That, to me, looks like there's going to be a higher deficit. And that, in turn, is likely, in my view, to lead to further depreciation in the dollar. And that's liable to be helpful for gold. So all of that is part of my bullish outlook as far as gold is concerned, is because of all of these factors. Obviously, I don't know what a sustainable debt level is, whether it's the budget deficit or the total debt. And clearly, if they've been saying it's unsustainable for 20 years and it has been sustained for 20 years, then clearly the economists don't know those levels either. I think we all have to try to get used to accepting that we don't know what is a sustainable level. I'd like to see them come down, I think, for the economic health of this country. But for the time being, I think that both of them are part of the atmosphere of uncertainty, of concern that is driving investors into gold. And that's the most important thing from my point of view right now.
Let's wrap with this and just bring it down to a relatable level. Forget what the economists are saying. What do you think the economy is like for the middle class American?
I think that there are problems for many different strata of society. I think that, working class, that's very, very difficult. It's maybe a tad easier for the middle class, but nevertheless, I think that there are difficulties there. The economy is not working the way that I hope the way that I hope it will, and the way that I believe it should. There are real problems with our economy. I am not seeing any major solutions at this juncture, but I hope that we will get some once we've got the election out of the way. There's always a lot of talk going on around elections. Election promises, I think, for the most part, don't hold up once people get into office. So I'm looking forward to seeing what happens after January of next year when we have a new president. I'm looking to see what that president's going to do in relation to the economy, and what that president's going to be able to do given the possibility of a divided Congress.
George Milling-Stanley, thank you so much for joining us here on the Daniela Camboni Show at ITM Trading. Thank you for your viewpoints.
Thank you, Daniela. Great to see you again. I look forward to talking to you again soon.
You as well, George. Thank you. And thank you all for watching. We'll have more great content coming your way. So be sure to sign up at danielacamboni.com and simply subscribe to our YouTube channel so you can stay on top of it all. We will see you soon. That's it for me.